Document found a new Citigroup report confirming that $16 trillion in estimated assets are going to be moving on blockchain rails by 2030. That's less than 5 years from now. As some influencers may tell you, crypto is going to replace Wall Street. That's not the case. Crypto is not replacing Wall Street. Wall Street itself is adopting blockchain as the new infrastructure. The United States Department of Treasury estimating that stablecoins are going to hit a $2 trillion market cap by 2028. The DTCC, or Depository Trust and Clearing Corporation, the giant that clears $2.5 quadrillion in securities annually, filing patents showing how this new system is going to work. And the Global Blockchain Business Council, with infrastructure providers such as Hedera, Ripple, Chainlink, Cardano, and Avalanche, moderated by the World Bank, DTCC, Clearstream, and Euroclear, are mapping out how this compliance aspect is going to work. This is quite literally the biggest financial upgrade of multiple lifetimes. I'm going to start with this Citi report. That is the report that just came out. They title this Security Services Evolution 2025. The big graphic to pay attention to here in the title of this video is anticipated market volumes using tokenized or digital securities by 2030. They're saying $16 trillion in digital asset turnover within the next 5 years. That's much higher than where we're at right now. Obviously, we're right around probably $50 billion in RWAs, or real world assets, that have been tokenized as of 2025. This entire report basically talks about not just crypto coins. We're talking about bonds, traditional bonds. We're talking about traditional funds. We're talking about traditional collateral, private markets. 3 unstoppable use cases from this Citigroup document. Tokenized collateral, moving trillions, literally trillions of dollars in real time. Tokenized funds, instant subscriptions and redemptions, business to business. Private markets digitized, unlocking illiquid assets. That's kind of the key to the entire tokenization puzzle here, is bringing liquidity to assets and markets that historically have been illiquid. Some other interesting statistics within this, which we'll go through here in just a second. This matches DTCC, or Depository Trust and Clearing Corporation's own patents on tokenized collateral. We brought this up a couple of months ago and discovered this patent. And let me pull it up for you. This is essentially tokenizing quadrillions in global assets with centralized control. They still want to maintain that control. When the world's largest clearinghouse and Citigroup are aligned, this isn't just theory at this point in time. This is literally the infrastructure. Stable coins are taking over as well. Real digital money. And we've seen kind of the push forward in the United States with the Genius Act as well. Stablecoins and tokenized deposits. The United States Department of Treasury is estimating that stablecoins could reach $2 trillion by 2028, as we can see here. And this isn't about fringe markets. This is a new global settlement layer. The question I have to ask is, which networks act as infrastructure as stablecoins start ruling the roost? Think about it today. We use Swift, or Swift is used to send messages throughout the world. There's promissory agreements between institutions to then move value. In the future, as Swift moves these messages, stablecoins are essentially going to become that stable form of digital money between these economies, between these businesses. Faster, cheaper, compliant, and available 24/7. Custodians and financial market infrastructures also in the lead here. Here's the twist that most people miss. Blockchain isn't replacing custodians and clearinghouses. They're building into each other. These markets are going to start converging, especially as the regulatory clarity comes down the pipeline. This is why we see initiatives like this risk mitigation framework with Hedera and Ripple and Chainlink and DTCC all working together. 52% of firms expect financial market infrastructures like DTCC and Euroclear to manage tokenization in the future. 29% expect custodians, and this is from the Citigroup report, like Citigroup and BNY Mellon, to provide multi-chain access. That means that it is not about one network to rule them all. It is about the most compliant, the most efficient networks, kind of having that liquidity pathfinding and everything else that's going to happen as these markets start converging. In other words, the existing financial system is quite literally merging with blockchain, turning it into compliant global scale rails. This is not disruption. This is an upgrade to the system, ladies and gentlemen. I want to move forward to this. DeFi essentially meeting with and merging with traditional finance. DeFi, or decentralized finance, is a term that kicks around the crypto landscape quite often. Used to be seen as experimental within traditional financial institutions like banks. But now its best features are literally merging with traditional systems. Some of these features include 24/7 settlement, programmable money and assets, liquidity pools that move instantly. Institutions aren't ignoring what's happened with DeFi, they're adopting it, and they're adopting it compliantly. Coinbase is licensed in Europe and across the world. Clear Token building clearinghouses for crypto. Chainlink quite literally connecting all of these financial institutions. Ripple and the XRP ledger quite literally have built the rails for last mile settlement with XRP and now certainly with Ripple USD. Hedera positioning itself as the trust layer of the digital economy, one of the greenest networks on planet Earth. And as we can see, all of these entities do kind of work together in these different initiatives like the Global Blockchain Business Council, which I will show you right now. This is this risk mitigation framework. As we can see here, capital markets, led by industry leaders to help financial institutions identify, evaluate, and minimize non-financial risks associated with blockchain infrastructure, particularly public blockchains. Prioritizes the integration of blockchain risks into existing enterprise risk frameworks. These systems, as I said, are converging. The core contributors in phase one are Avalanche, Cardano, Hedera, Ripple, as kind of the blockchains. You've got Clearstream, DTCC, Euroclear, Oliver Wyman at the legal standpoint, but Clearstream, DTCC, and Euroclear filling the traditional market infrastructure. The World Bank is observing this. In phase two, you've got Canton Foundation and Chainlink. You can read more into this risk mitigation framework if you'd like. So again, the GBCC or GBBC report, and there's multiple documents out there about this now, co-published with these entities. This is essentially, they're building out this compliant infrastructure. So I've got to wonder again, Hedera and the HBAR ecosystem for enterprise governance and sustainability, or XRP for settlement and CBDCs, or Chainlink for interoperability and trusted data feeds, even settlement, or Avalanche, subnets for tokenized assets. Citi projects the size of this flood. The Treasury says stablecoins are the money. And DTCC has the patents. Global Blockchain Business Council is naming some of the networks building out that compliance. This is basically the global infrastructure stack of the future. Geopolitics and competition is also kind of occurring right now. The United States, Europe, United States finally catching up, Europe and Asia arguably still in the lead. Anyways, the first $16 trillion based on what Citigroup is stating here in tokenized liquidity will flow. And that's going to flow much sooner than most of us anticipate. So let's connect kind of the final dots and ramp this down here. You have Citigroup projecting $16 trillion in assets by 2030. You have the US Treasury predicting $2 trillion in stablecoin market cap by 2028. You have DTCC filing patents to build the rails. And if I hadn't shared this, I'll share this one more time with you guys, just so you know. You can see the networks that were mentioned in this DTCC patent: Bitcoin, Ethereum, XRP, HBAR, Ethereum. I already mentioned Ethereum. Tron is in there, I think. So anyways, and we all know that Chainlink is like deeply integrated with DTCC. This isn't crypto hype. Again, this Citigroup document is 28 pages of just massiveness. I mean, I didn't even cover all of it. ISO 20022 stuff for all the ISO 20022 heads is in there. Literally, the traditional markets are converging with crypto and blockchain. The only question that we have to ask ourselves, really at this point in time, are which networks have a seat at the table, and then especially as we move from $50 billion of assets tokenized up to multiple trillions, up in the teens, and that'll be interesting to watch. Which networks capture the lion's share of global tokenization? And as we all know, you get up into the quadrillions with entities like DTCC. Once 10% of the world's securities are tokenized, we're not far off from 20%, 30%, 40%. It's getting to that first 10% that's going to take the longest. And you've got literally Citigroup, one of the biggest financial entities in the world, telling you that we are less than 5 years away from that occurring. Drop your thoughts in the comments, which entities you think might take the lion's share of that in the future. And if you like actual research, please like this video, subscribe for more content, and share this video, because the $16 trillion tsunami that's coming onto blockchain and the traditional financial system merging with blockchain isn't coming. It's almost already here.